What can the lumber price tell us about equities volatility? Well, actually quite a lot. The market is a very interesting thing to analyze when you piece together different variables in correlation with each other. And our next guest has done just that. He's looked at the lumber to gold ratio as an indicator of volatility. Very interesting discussion we'll be having with Michael Gayed, portfolio manager at Toroso Investments. Michael, welcome back.
Yeah, my pleasure. Thank you, David.
We spoke a few months ago, actually, and a few weeks to a few months. Time has been floating in a different dimension for me, but not too long ago. And we were talking about equity volatility and the risks. Now, you look at the lumber to gold ratio. I'll just let you explain what this ratio means in terms of predicting volatility and how does it work?
Yeah, no, I appreciate it. So everything I do is around trying to identify conditions that favor an accident in the stock market. I've put out 5 different white papers that won 5 different awards, and one of the papers documents the relationship of lumber relative to gold. So what that relationship suggests is that generally when lumber is outperforming gold over a short to intermediate term period, you tend to have a better environment for risk assets, meaning you would have lower stock market volatility, tends to coincide with risk on conditions. And the reason for that is that is the link is around housing. Right. So we know that housing is a leading indicator of the economy. Most people's wealth is in their homes, and the average home has about 16,000 board feet of lumber. So it stands to reason that if housing is a leading indicator, well, then lumber, by extension, because of the long tail of construction, must be as well. So as lumber performs, there's all kinds of implications on, again, growth, inflation, credit creation. Gold, on the other hand, is more of a safe haven commodity, meaning that when you have these high risk periods in the stock market, gold for a moment in time tends to do fairly well. So when you compare lumber to gold, it actually tells you a lot about risk. So yeah, obviously lumber has been unrelenting in terms of its outperformance against gold, which has been consistent with the risk on environment that we've seen. The thing which is kind of curious to me about the relationship is that the last time the lumber to gold ratio was at the level it's at today was in early 2005, just as the housing bubble was about to start getting unwound. It's some ominous signs, I think, that are happening there. But from a risk-on, risk-off perspective, lumber is quite telling in terms of broader risks and tail event potential in equities.
By that extension, have you looked at a housing price to gold ratio? Or is that,
not. It's a good question. So not in that sense, because the nice thing about lumber is that it's real-time pricing, right? Because you can track it based on the continuous contract futures.
Yeah.
Housing, as you know, you don't really know what the real-time pricing is. But speaking about housing, another sort of metric that would sort of suggest we're maybe entering some bubble-like territory, potentially, is the median home price to income chart, which basically shows that you're not quite at the levels of the peak from 05, 06, but you're kind of trending in that direction. And housing is getting unequivocally unaffordable. So I think this is going to be sort of an interesting thing where the price rise in lumber, which obviously has happened because of sawmills being shut down, labor shortages, and all this, at some point it prices out construction, it prices housing itself, of course, prices out new buyers. And that may actually result in some kind of a higher risk period that everyone should be aware of.
You've done a study on the relationship between the gold to lumber ratio and the VIX, the volatility index. So tell us how these two variables play together.
So look, I always say that, again, I may not know the exact mile marker. I might crash my car, but I know the conditions that favor the accident. The mile marker is the VIX. Right? Everybody always tends to react off of the VIX. My approach is much more around try to identify what could cause the VIX or the conditions that favor a VIX spike. And historically, prior to every single major crash, correction, bear market, prior to almost every single major VIX spike, the lumber to gold relationship warned, meaning lumber underperformed gold in advance of those VIX spikes. Happened a month before the 1987 crash, happened middle 1990 before the bear market there, happened 2000, 2001, 2002, 2008, 2 weeks before Lehman Brothers, even 2011, the summer crash where you had a Eurozone crisis. Draghi says whatever it takes. And guess what? Lumber to gold also warned then, even with COVID. Prior to the enormous VIX spike, the 80 level that we saw last year, lumber to gold warned. Now, it's important to know, by the way, that just because lumber to gold has tended to get ahead of major VIX spikes, it doesn't mean that every time you see weakness in lumber to gold, you have a VIX spike. Just because it's raining doesn't mean you'll crash. Just because it's sunny doesn't mean you won't. This is a game about conditions and probabilities leading to outcome. My point here is that the move with which lumber has occurred, the speed with which it's occurred, makes it actually more vulnerable to mean reversion, meaning a sell-off in lumber, outperformance in gold. and potentially then another sort of stormy environment. Whether or not stocks crash, you don't know until after the fact. But I do think that investors should be wary that there might be some interesting junctures to buy lower later down the line.
So just to clarify, you said whenever there's weakness in the lumber to gold ratio, that usually leads a spike in the VIX. By weakness, do you mean when the lumber price is low relative to gold? Because that's the reverse of what's happening right now, right? Just help me understand.
Right, exactly right. Right, and so to your point on the reverse, that's why equity markets have been quite strong. Right, everything that we've seen is actually pretty consistent. It's when you have a reversal of that performance, meaning lumber is underperforming, which would be down more or less against gold. That's where there might be a high risk juncture.
So actually, we're in a very bullish environment right now for the foreseeable future. Is that what you're trying to tell us?
Yeah, so certainly it's been justified because of the way lumber's behaved, right? Everything that's happened so far this year is consistent with history as far as lumber as a leading indicator of risk on. My point, though, is that the move has happened so quickly. And I always used to say on the road when I was presenting at CFA chapters that the one thing you can bet on in markets, the one thing you can maybe say is a guarantee, is mean reversion, right?
Yes.
And mean reversion is a concept that's as old as the Bible, right? He who is first shall be last and last first is by its very definition mean reversion. Given the speed with which lumber has moved, and especially relative to gold, I think there's going to be a mean reversion moment in lumber prices that could result in a crash in lumber, just sort of a taking out a lot of this froth that's happened in the space. And that might be your warning sign for a crash then to follow, or some at least high risk, high volatility period for equities afterwards with a lag, consistent with history.
That's very interesting. Let's talk about the two variables, lumber and gold, and what can move either one of those. And then we'll talk about the timeline for this potential mean reversion that you're talking about. So lumber, as you know, has skyrocketed over the last year. It's gone up more than 220% last I checked since 12 months ago. What was the cause? What were some of the main causes of this price rally?
Yeah, I mean, you had two dynamics, obviously. It's clearly the shutdown. And keep in mind, when we're talking about lumber, we're talking about sort of finished lumber, right, which is what's sold in Home Depots, right? It's what goes into the houses. So it's really more on the sawmill side. There's plenty of trees out there. It's just a matter of sort of getting it in a form that can be used in construction. So, the fact that you had these shutdowns, supply disruptions, you had tariffs with Canada, all this, you can argue, sort of created a perfect storm for lumber to do what it's doing. And of course, everyone staying home resulted in everybody wanting to do more work on their homes. But again, I think it's getting to a point where it's getting to be more of a problem. I put a tweet out on @LeadLagReport, my Twitter account, a couple of weeks ago. And the question was, how many of you are thinking about remodeling or delaying remodeling of your homes because of the price of lumber, just kind of holding off on construction? And I got a lot of comments, almost 100 comments. And if you go through the comments, you'll see somebody saying, I was going to replace my wooden fence and now I'm not going to. Or a lot of people saying their contractors were supposed to do work for them, but they're slow playing them on actually starting work because they're hoping that commodity prices go down. So I do think a lot of this is going to result in some kind of slowdown, and that could itself also cure price, because if you have a slowdown as supply is ramping up because sawmills are coming back online and more people are getting hired to do that work, that's another reason for why I think that ratio could collapse.
Yeah, I read your work on this, and you've written that lumber also is in itself an indicator of economic growth. And so that makes perfect sense to me last year. Like, we've had a period of recovery since the pandemic, and you've given lumber has risen for all the reasons that you've stated. If the price of lumber were to mean revert, were to come down, would that not in itself be an indicator of a slowdown in the economy? I'm asking. I don't have an answer to that. I've observed a few indicators for Canada, for example. The unemployment rate just actually went up. I don't know if you think that the economic growth that people are expecting is actually as robust and as strong as it could be.
Well, and to that point, I've been writing about this quite a bit in the Lead Lag report itself. So, I'm a big believer in intermarket relationships, right? How does one part of the marketplace react to others? What's curious to me is that when you look at 10-year treasury yields, okay, you look at bond yields, they pretty much peaked out mid-March, despite commodities, lumber, all kinds of other industrial plays continuing to surge higher. Now, commodities are supposed to be a form of cost push inflation, right? As commodity prices rise, you would expect yields to rise because it means inflation expectations have to get priced in. Well, the bond market stopped doing that, even though commodities are still running higher. So it could very well be that the bond market is now sniffing out the idea that the speed with which commodities have run higher may actually be damaging to the economy, may slow down economic growth, which again makes sense. It's funny because when people talk about commodities, they always think it's automatically inflationary if prices go up. It depends on the speed with which it happens. If commodities move up gradually, the argument is that that's inflationary because companies start believing that the trend is entrenched. They start passing down those higher commodity prices to consumers. Well, now what happens if the move in commodities is too sharp? What if it's spiky? What if they don't have time to pass down those costs? Well, now it impacts company margins, which means it's actually not inflationary. It's actually deflationary for a moment in time. Right. And that goes to your point that they could actually suggest, if you have this sort of broad mean reversion in the space led by lumber, that yes, it probably is going to be more an indication of a break in demand. And that should probably mean the economic activity itself is going to be going at a slower pace than what everyone thinks it will.
Let me ask you the question in a different way. If lumber were to fall down, if the price of lumber were to come back down and mean revert, what would cause that correction? Would it be a slowdown in housing and housing starts, economic growth and demand, or is it just a technical correction from, let's say, a price, supply, demand equilibrium perspective? It's just gone up too much. It has to correct a little bit. What do you think?
Yeah, I think probably a little bit of both. I mean, I think the reality is there are technical aspects to what's happened here. It's funny, if you look at the chart of lumber since 1980, it looks like a black swan. I mean, it looks like Bitcoin. It's not justified from a lot of perspectives, right? Mm-hmm. So, and again, and you can also argue, listen, so you go back and lumber crashes to the level it should be. That's not necessarily an indicator for stocks to crash. That could be absolutely true. But again, I go back to the bond market doesn't quite is not reacting on the sort of economic growth narrative that's being pushed out there. And and I say this from the perspective of somebody who's running an ETF. I'm a portfolio manager of the RORO, risk on, risk off ETF. I track lumber to gold because that's the trigger to go risk on, risk off. I'm actually looking forward to lumber collapsing so that the ETF can go risk off into treasuries. And I hope there is an actual risk off period because, as I always say, if you want to kill it in the stock market, you have to not get killed. If you can avoid the major declines, and lumber to gold may be warning about that down the line, that's a big deal.
Well, if you're anticipating the lumber price to collapse, would you not go risk off now in anticipation, or is that too soon?
Yeah, no, very good point. So when you're doing a rules-based approach, you have to kind of follow it, to its logical conclusion, which means you don't try to front run it. So right now, the momentum clearly is on the side of lumber to gold, and it's these things obviously seem to go out longer, continue longer and further than most think. My point is, this is a juncture where, unless you have like a systematic approach, like I'm doing with the RORO ETF, you might want to be very careful about taking too much excess risk, given that this could reverse at a moment's notice. Okay,
good point. What about the gold side now? It is a ratio after all. There are two variables involved. If lumber were to fall down in spite of, or perhaps despite, all the other economic variables that we've discussed, what would that mean for gold? Would lower economic activity mean gold could go up, hence the ratio would contract even more, or could gold fall because of risk offset? Walk us through your rationale here.
Yeah, so gold is, I think, in a really interesting juncture. So if you think about it, right, you only have really three major risk-off assets that benefit from stock market volatility. Historically, it's treasuries, the dollar, and then gold, meaning gold tends to benefit when you have these kind of drawdowns or corrections. Well, if you have a collapse in lumber and that precedes some kind of a corrective or collapse type of juncture in equities, I think a lot of people would be probably wary of treasuries. I think treasuries would rally, meaning yields would fall like they historically do, but gold probably might even get more attention because people have this sort of inherent, I think, bearishness against treasuries as any kind of a trade, right? So I'm arguing actually that gold could be, for a moment in time, an interesting risk-off play. And I think that you could spark some kind of real momentum in gold. I mean, gold relative to every other commodity has largely lagged and underperformed. There's going to be a mean reversion, I suspect, within the commodity space too.
Okay, it's interesting. One would suspect that lumber and gold should have an inverse relationship, should they not? Yet, if you just look at the price pattern of the two variables over the last year, they clearly moved more or less in the same direction. Well, gold has come off since its highs. Lumber has kept going up. But beside that, they've more or less moved in the same direction. So right now, the ratio has widened because lumber has continued to go up while gold has fallen down. So the ratio has widened. When do you think this ratio will lower down and compress? Can you give us an estimate of the timeline? Has that been something you considered?
Yeah, it's hard to know the exact moment you might
Yeah,
crash your
yeah,
car, but
for
again,
sure.
the conditions there, right? So I think that it's so stretched that when you see, and I've seen this many times before, when you have such a relationship that's this stretched, it doesn't take much, to break it.
Right.
So
Like, let's put it
I
this way.
wouldn't.
Historically speaking, let's say when the yield curve inverts to a negative territory, it's usually 6 months before the start of a recession. So
Okay. Yep.
your indicator historically, whenever it spikes up and peaks the ratio, typically how many months before it comes back down?
Yeah, so that's what's interesting, is because you've never really had a juncture where you've had a spike like this. So even if
Oh,
there were
okay.
some sort of like sample size, right? But I will say about that historically, when lumber is underperforming gold, in the case of the white papers last 13 weeks, the ETF I run, RORO, is a slightly different look back period. But
Mm-hmm.
typically, if lumber starts weakening against gold, it's within 2 to 4 weeks if it's going to be a true signal for the
Mm-hmm.
stock market itself to start reacting, right?
Mm-hmm.
And that's so you have some time conceivably if lumber starts breaking. My point is pay attention to it.
Okay, perfect. And once this ratio does compress, once lumber does collapse, you've got a few more weeks before the equity markets react to the downside. Is that what you're saying? Okay,
That's
and
historically how it has tended to play out, right?
perfect. Okay, so we've got some time for the markets to mean revert. Now, which particular markets would be most at risk from this compression of the ratio?
Yeah, look, I think there's a few things I was saying on Twitter. If you understand this, right?
Mm-hmm.
I think there's so much leverage across all risk assets that it's hard to say something will get hit more than the other. This may sound like a strange concept, but it wouldn't surprise me if what ends up going down the hardest is the entire cryptocurrency space. Now, some people are going to laugh when I say that. It's like, why am I making the case that if lumber breaks, cryptocurrency breaks? It's not that cryptocurrency alone would break. It's that levered assets would break,
I
right?
understand.
Because again, if you have lumber weakness, it would suggest a deflation pulse. And for the most part, what's going on in the cryptocurrency space is just a levered play on equities. I mean, they are ultimately a risk-on reflationary type of trade that's happening across the space, not just Bitcoin. So, I suspect that's where you might have some interesting spillover where lumber weakens. That suggests that there's a liquidity coming out of the system. You have a deflationary pulse because of that. Risk assets start responding. Crypto would probably be at the forefront of that. That's not a case against cryptocurrencies. I'm simply arguing that the sequence of returns, it might be more challenging than people think.
I'm sensing that you think cryptos are slightly overvalued right now. That somehow their valuations are overstretched. Please correct me if I'm wrong, but if I'm not, please elaborate.
Yeah, no, I know it's funny. I mean, that assumes that anybody knows what the real valuation is. I mean, that's kind of the funny thing about cryptocurrency. So look, I've made this point on Twitter. I sympathize and I totally actually understand and recognize the power of the space. The argument is that when you can print an unlimited amount of dollars, it's a Ponzi scheme. That's those who people look at, U.S. government debt. That's the argument, right? It's all Ponzi scheme. Well, so you print an unlimited amount of dollars as a Ponzi scheme, but then again, you can make an unlimited number of cryptocurrencies, different types. I think there's over 4,000 that are out there. There are things that are going up which make 0 sense, which are clear Ponzi schemes, even in the way the algorithms are constructed. So the entire space has this dilemma where Bitcoin is the shining star. You have all these altcoins that are getting all kinds of attention, but it creates even more speculative mania, which at some point will again spill over to other risk assets. So to me, it's fascinating to see how this plays out. I don't know if it's a question of valuation. I think it's a question of speculation, and the speculation's at an all-time high.
That's a good point. I have considered that before, which is that the bigger coins like Bitcoin, for example, have a market limit in terms of the number of coins in supply, but there isn't a limit on the number of coins or altcoins you could create. This is a good counter argument to that notion here, which is that if you compare cryptos to, let's say, equities, for example, right? There's no limit on the number of startups in an economy you could have. The number of startups in itself is not an indication of whether or not the crypto space is that this equity space is overspeculated or overvalued, right? Because not all these startups succeed. Likewise, not all the altcoins would succeed. Not all of them would attract capital. Most of them probably just fizzle out and die anyway.
Right.
Although
it's interesting though, because real quick on that, because that's an interesting thing to think through. So, unlike the .com era, right, where stocks would come in, they put .com after the name, they go up, and then they just disappear because of bankruptcies. These cryptocurrencies are pieces of code. They don't actually disappear. Right? It's not like a company that can no longer exist, right, because it goes bankrupt. These Dogecoin, if it were going to go back to its all-time lows, would still be something that's traded. right? Which is I think it's an interesting dynamic also there from that standpoint, which is why it's just fascinating to kind of track.
Well, let me ask you just more broadly. Do you think that Bitcoin is at risk from rising altcoins? Do you think that the whales, so to speak, the larger holders of Bitcoin who occupy a significant portion of the market cap, do you think they would be dumping their holdings into something like XRP, Polkadot, whatever have you?
You know, it's interesting. I remember I was at a conference a long time ago, and somebody once said that diversification is a luxury for the rich. And the implication, of course, is that if you want to get very wealthy, you've got to take concentration conviction bets. So if you got these kind of large holders in Bitcoin, maybe they will stay to it because they have such a sort of, you can argue, almost religious fervor in what they're buying. But it's like you enter this world without Bitcoin, you exit this world without Bitcoin, right? Okay. So if you think about it from that standpoint, maybe you see some diversification into other altcoins or things like that. Who knows, right? There's no way to know. But I do go back to, I think there are a lot of people in the space that are simply buying these cryptocurrencies just because they're going up in price, not because they really understand what they're buying. And they're regurgitating a lot of these tweets and lines that are being said by these gurus on the street. Listen, at the end of the day, if you have a real correction or crash, we'll see how many diamond hands there really are.
Look, you're a portfolio manager. Have you not considered building some sort of algorithm or a strategy, if you want to call it a strategy, basically some sort of methodology that basically tracks Elon Musk's tweets or whatever other influential figure you have, and just buy whatever he tweets because it's been pretty consistent. He's been successful at pushing up Doge, Bitcoin. I can't remember what else, but so far the track record's been pretty good. How would you respond to that?
Yeah, no, it's like he's America's favorite fiduciary. And he's not supposed to be a fiduciary, right? I mean, it's interesting because I feel for the people that are like taking real risk and launching real businesses in the blockchain space that are focused on Bitcoin, because it kind of makes a mockery what's going on with Dogecoin and some of these other areas of their life's work. And so even like within the kind of cryptocurrency community, you have the maximalists who are believing that Bitcoin will eat the world, but then there's even a counter argument within the cryptocurrency of other, Bitcoin against Doge and all these other things. So, yeah, I mean, listen, look, we're in this influencer-driven world, and I think we're in a world where people are simply just following the leader who has the most social proof, which is unfortunate because that's the risk is always up.
I use Musk as an example, but you're absolutely right. He's not the only influencer out there to do this. They all seem to come out at the same time. But my question is, as a fund manager, would you not even a fund manager, but as an investor, would you not at least consider just following the herd? Is that a good strategy for people? Because for a lot of people who may not have a lot of money to diversify, like you said, maybe they're not privileged enough to diversify, that's what they're doing. They're going on Reddit, they're seeing what's hot, trending, and they're just following the herd. What's wrong with that? Is there a danger to that?
No, listen. Yeah, no, there's nothing wrong with it. If you're one of the lucky ones that can get out at the right time, God bless you. My point is, if you don't know when to exit, how do you know when to enter?
Yeah.
Right. Okay. So I think that's sort of the view that, look, you can always make money for a moment in time. It's like we've seen some of these stories with GameStop with the Reddit and everything that happened earlier in the year where people made a couple of $1 million and then they gave it all back. Right. Yeah. It's not permanent. Just because you're making money now doesn't mean you'll make money later, because when it breaks very quickly. And our bias is to hold, because you always want to get back to making the money that you made at the peak, not what it is now.
Okay.
Loss aversion is very real.
Fair enough. Tying all this together now, final question: how are you positioned, given that the lumber to gold ratio is very high right now, and given your outlook on the economy and risk position now and potentially down the line, how would you rotate capital?
Yeah, so again, the risk on, risk off RORA ETF, is still risk on, meaning it's fully equities, and it should be able to evaluate the trigger every Friday, which means at the end of every week, it potentially could do a full-on switch. It's very dynamic from that standpoint. Not very many people can do that the way that we do this in that ETF. What I will say is that, again, I go back to, I'm kind of excited for what's to come. Look, I have an incentive to want to talk about risk off, because alpha and outperformance doesn't come from being up more, it comes from being down less. It always comes from the tails, right? So why so few people can beat the market on the upside, because it's not about the upside, it's about the downside. So I'm simply excited because I do think there are going to be a couple of these swings. And by the way, maybe it is going to be this tax debate that causes that too. I mean, you always kind of say to yourself, what's the catalyst, right, for anything to break? Well, if you're going to have increased taxes combined with higher commodity prices, well, guess what? Consumer spending is about to get crushed with that combination. Right. So I think there are a number of things out there that people should just be aware of. I'm doing it systematically. If you're doing it for yourself, All that means is be wary, don't get too caught up in the uptrend, and recognize that things can turn on a dime, because when you have this much leverage in the system, it doesn't take that many butterflies flapping their wings to create a hurricane.
Before I let you go, Michael, let's elaborate on the tax impact on the equity markets a little more. And also, we haven't talked yet about the magnitude of a potential correction should the lumber to gold ratio mean revert.
So again, if you understand this about taxes, every single round of taxes, every single increase in the amount of money that's being paid to the government, it's never used to pay off prior debt. It's used as justification to take on more debt. What I always keep on ranting about on Twitter, again, at Lead Lag Report, is that if you're going to raise taxes, then you should also lower spending at the exact same time. If you're just going to raise taxes and keep on having that trajectory of the deficit keep on rising, what's the point? And by the way, just because you're going to tax the very wealthy, I made this point before. If you were to calculate all the billionaires in the U.S. and you're going to tax all of them, you're going to take all their money. You don't even tax them; just take all their wealth outright. You'd only fund the government for 11 months. Meanwhile, the real tax that isn't out there, but people see it every day, is at the grocery. It's through rising prices of goods. It's through the very inflation we're talking about, which all the spending is going to ultimately create more and more of longer term. So, it's beyond my understanding how nobody seems to want to address the spending side of the equation. And that, again, if debt doesn't matter, and I've used this line before, why are we paying taxes? I think at some point the market's going to start waking up to that. Could be another catalyst for that lumber to gold ratio to collapse. And going back to your point about the magnitude of the correction real quick, There's no way to know. I suspect that just given how far we've come and how aggressive the move has been, it wouldn't surprise me at all to see a 10, 15, 20% easy correction. I don't think you would have anything near like what we saw last year. Mm-hmm. And I'm saying that because it's very clear the Federal Reserve is pot committed, meaning they're not going to let this thing go down substantially, right? They'll try and put a floor in after for a decent sized decline, because look, at the end of the day, they have no choice. If they have to start buying stocks just like the Bank of Japan has, they will.
Michael, excellent report as always. Thank you very much for coming on the show. And let's follow up in a few weeks when maybe things take a turn and we'll have a different story to tell.
Yeah, no, definitely. Appreciate it, Dave. Thank you.
Thank you very much. And thank you for watching Kitco News. If you're watching this on YouTube, please don't forget to subscribe. I'm David Lin.